Welcome back to Smart Stock Sam, the channel where we cut through the noise and get straight to the trades that matter. Before we dive in, smash that like button and subscribe if you are new here, because today we are covering one of the most explosive stocks on the entire market right now. I am talking about a company growing its revenue at nearly 700% year over year, a fresh all-time high just printed on the chart, and a $27 billion contract with one of the biggest tech giants on the planet sitting on the books. We are talking about Nebius Group, ticker symbol NBIS. Today, we are breaking down the Q1 2026 results, the jaw-dropping technical setup, and a complete trade plan, including a medium-term price target of $250. Is that target realistic, or is this stock already flying too close to the sun? Stay with me, because the answer might genuinely shock you. Here is the roadmap for today. We cover the headline numbers, crack open the revenue mix and profitability, then hit the gap reality check. Because there is something buried in the financials every investor absolutely needs to understand. After that, we go through the technicals, the Nvidia partnership, the U.S. infrastructure buildout, the full-stack neo-cloud strategy, the guidance, the risks, the analyst sentiment, the short squeeze setup, and the exact trade plan with entries, targets, and stop levels. Complete deep dive. Let us get into it. Now, if you have been sleeping on Nebius, and honestly, most people still are, here is the 30-second history you need. This company was originally Yandex, the dominant search engine across Russia and Eastern Europe. After geopolitical upheaval forced a massive restructuring, it rebranded, pivoted hard into artificial intelligence infrastructure, and relisted on NASDAQ. Most retail investors still see it as a restructured European search engine. That mental model is dangerously outdated, and the Q1 numbers prove it. Revenue for Q1 2026 came in at $399 million. That is a 684% explosion compared to the same quarter last year. Let that number breathe for a second. 684%. The catalyst that has institutional desks absolutely buzzing is a $27 billion five-year contract with Meta Platforms. Think about what that actually means structurally. Meta is locking in Nebius capacity for the next half-decade. This company now has the kind of revenue visibility that most early-stage growth companies can only dream about. Analysts are calling this the performance validation phase, where Nebius transitions from a restructuring story into a legitimate infrastructure giant. They are aggressively expanding their United States data center footprint and positioning themselves as a credible alternative to the big three cloud providers. Do you think Amazon, Microsoft, and Google are watching this? You can bet they are. Now let us peel back the revenue number, because the composition tells an even more powerful story. Their core AI cloud segment grew 841% in a single year and now accounts for 98% of total revenue. The old business is essentially gone. This is a complete and total transformation of the business model. But here is where it gets really interesting for the bulls. Nebius just hit a massive profitability inflection point. 1 year ago, they were burning cash with a $53,700,000 loss on an adjusted EBITDA basis. Today, they have swung to a $129,500,000 profit. Even more impressive is the margin story. Their AI cloud segment is operating at a 45% adjusted EBITDA margin. 45%. For a company scaling at this velocity, that is elite-level operational efficiency. The cost of revenue as a percentage of sales dropped from 49% all the way down to 26%. The leverage is real and it is moving in the right direction. But here is where Smart Stock Sam gets into the details that most channels skip, because I need to be straight with you before you consider putting a single dollar into this name. The GAAP net income headline number of $621 million is highly misleading. That number was propped up by a $780,600,000 non-cash gain from the revaluation of their stake in ClickHouse. Strip that away, and the company actually had an underlying operational loss of approximately $159,400,000. Depreciation and amortization also jumped 332% to $212 million. And that is the literal cost of all those expensive Nvidia H100s and B200s they are buying to run this empire. I am not saying this to scare you off the trade. I am saying it because the adjusted EBITDA story is genuinely exciting. But you must understand what is underneath the GAAP headline. This is still a high-burn, high-growth machine that requires enormous capital to stay alive. Now you know. Now let us look at the chart. The technical picture is, to put it bluntly, extraordinary. NBIS is trading well above its 50-day, 100-day, and 200-day moving averages simultaneously. That stacked moving average alignment is a textbook characteristic of a true leadership stock. The MACD is flashing a strong buy signal with a reading ranging between 7.4 and 12.6. Momentum is firmly in the bull's corner. Now, here is the nuance I need you to hear. The 14-day RSI is sitting at 61.3, and it is creeping toward that 70 level that signals overbought conditions. This tells us the stock is entering a zone where short-term consolidation becomes more likely. But here is the honest truth. When the news flow is this powerful, normal technical rules get stretched. This is not a normal environment. The trend is up, the momentum is up, and the fundamentals are providing the rocket fuel. One major reason those technicals stay so strong is what I call the front row seat advantage. In a world where every AI company on Earth is scrambling for GPU supply, Nebius has something nobody else has. Nvidia did not just sell them chips. Nvidia took an 8.3% equity stake in the company through a $2 billion investment. Read that again. The largest chip company in the world has skin in the game here. This guarantees Nebius priority GPU allocations, meaning while other cloud providers are waiting months to get their hands on Nvidia hardware, Nebius is scaling without those bottlenecks. This equity partnership is the ultimate seal of approval from Jensen Huang himself. Could Nvidia have picked any other neocloud for that kind of commitment? They did not. They picked Nebius. That tells you everything. And they are putting that hardware to work in some very specific, very powerful locations. Nebius is making an enormous bet on the United States. They already have a 1.2 gigawatt AI factory active in Missouri, and they just secured another 1.2 gigawatt site in Pennsylvania. Their target is over 4 gigawatts of contracted power by the end of 2026. Now, to put that in perspective, 4 gigawatts is a staggering amount of digital real estate. It is the kind of scale that makes this company infrastructure critical, not just infrastructure adjacent. However, not everything is smooth sailing. They are currently facing a class action lawsuit in Birmingham, Alabama, where residents are attempting to block a 300-megawatt facility over zoning and environmental concerns. Could that lawsuit expand to other sites? Could it delay timelines? These are the questions that keep risk managers up at night, and it is the biggest tail risk for this stock right now. But here is what truly separates Nebius from every standard data center play out there. They are not just a landlord for GPUs. They are building a full-stack neocloud that owns the entire AI pipeline from top to bottom. They have spent hundreds of millions acquiring companies like Eigen AI for inference workloads and Tavali for agentic AI applications, while also absorbing the research team from crwv. The vision is an end-to-end platform that handles everything from model training to real-time inference. By owning the hardware, the power, and the software stack simultaneously, Nebius can offer lower latency and better pricing than the legacy giants who are hamstrung by their own complexity. This is the neocloud advantage, and it is why customers like Meta and Microsoft are writing them checks instead of building it themselves. Could a legacy cloud player replicate this from scratch in 2 years? Almost certainly not at this scale. So where does management see all of this going? The guidance they just laid out should make every growth investor stop scrolling and pay attention. They are targeting an annual recurring revenue of between $7 billion and $9 billion by the end of this year. For context, understand that that is a jaw-dropping jump from current levels. They are forecasting 40% adjusted EBITDA margins as they continue to scale, and total 2026 revenue is projected to land between $3 billion and $3.4 billion. Here is the provocative question. If they hit $9 billion in ARR with 40% margins, does the current valuation actually look cheap? Run the math. The answer might surprise you. That said, if is doing an enormous amount of heavy lifting in that sentence, and the risk side of this story deserves equal time. The most consequential risk here is financial exposure. To reach their 2026 goals, Nebius needs to spend between $20 billion and $25 billion in capital expenditures. That is a mountain of cash, and as we covered, they are still relying on non-cash revaluations to show a GAAP profit. Customer concentration is another real concern. If Meta or Microsoft slow their spending or pivot to building their own custom silicon, Nebius loses its most critical revenue lifeblood fast. And the legal hurdles in Alabama are a preview of what can happen at any proposed site across the country. Permitting, environmental review, local politics, power grid negotiations, any one of those can slip. If multiple slip at the same time, what happens to the 2026 guidance? Now let us look at how the smart money is positioning. The Wall Street consensus is overwhelmingly bullish. 12 buy ratings, 4 holds, and only 1 sell. D.A. Davidson just raised their price target to $250, while Bank of America sits at $205. The average consensus target of $190 suggests the stock may be slightly ahead of itself, but institutional conviction remains very high. And if you spend any time on financial Reddit, NBIS is becoming a favorite for the momentum-driven retail crowd, which adds a volatility layer that cuts both ways. When retail and institutions lean the same direction simultaneously, you can get moves that defy any normal valuation framework. Here is the hidden fuse under this stock that could cause a violent upside explosion with almost no warning. Short interest is currently over 20% of the float, with 2.6 days to cover. That is a meaningful short position sitting on top of one of the hottest momentum names in the entire market. Meanwhile, the options market is aggressively bullish. The put-to-call volume ratio is a microscopic 0.39. We are seeing massive call walls building at the $200 and $220 strikes for the May 15th expiration. Traders are putting millions of dollars on the line, betting that this stock clears $220 in a matter of days. If the shorts get squeezed against that call wall, could this stock print $230 in a single session? The math on a short squeeze of this magnitude is genuinely terrifying for the bears. So let us build the actual trade plan. For the conservative entry, you want to wait for a cooling pullback into the $195 to $200 zone. That area served as prior resistance and now acts as both psychological and options-based support. That is your measured, patient entry. For the momentum chasers who want to buy strength, the aggressive entry is a confirmed breakout above the all-time high of $217.34 on heavy volume. Do not chase a breakout on thin volume. That is a trap. Our first meaningful resistance is that 217 high. Beyond that, the major call wall zone sits between $220 and $225. Clear that level with conviction, and the path to the $250 medium-term target is wide open. On the downside, the line in the sand is $175. A decisive close below that level puts the bullish thesis under serious pressure and would warrant a reassessment. Before we get to the final verdict, I want to leave you with the single most important metric for this entire investment thesis, and most people are completely overlooking it. I call it the conversion gap. Nebius has 4 gigawatts of contracted power. That is the demand. But their connected, revenue-generating power is only projected to reach somewhere between 800 megawatts and 1 gigawatt by year-end. That is the current reality. The gap between those two numbers is where this story either becomes legendary or falls apart. The demand is secured. The $27 billion Meta backlog is real and it is locked in. The supply side is a race against time, against construction crews, against permitting offices, and against the clock. Execution velocity, how fast they can convert contracted power into live, revenue-generating GPUs, is the single metric that will determine whether NBIS goes to 250 or retreats toward 100. Watch this number every quarter like a hawk. Now, before the final verdict, I want to be crystal clear about something important. Nothing on this channel is financial advice. Smart Stock. SAM is purely for educational and informational purposes. All investing involves risk. You could lose some or all of your capital. Always do your own due diligence, understand your personal risk tolerance, and consider consulting a qualified financial advisor before making any investment decision. The trade setups and price targets discussed today are my personal analysis and are not guarantees of any future outcome. Here is where we land. Nebius Group has successfully transcended its legacy identity and positioned itself as a vital utility provider for the AI era. They have a solid $9.3 billion cash position on the balance sheet, but they are staring directly at a $20 to $25 billion capital expenditure requirement. They have the demand locked up through Meta, and they have the hardware access guaranteed through Nvidia. And those two things are genuinely the hardest assets to secure in the entire AI infrastructure space right now. If Nebius stays on schedule with their US data center buildout, converts that contracted power into connected revenue, and keeps those AI cloud margins above 40%, we are looking at the emergence of a future generational infrastructure company. If they stumble on execution, if the construction timelines slip, if the legal challenges multiply, if customer concentration bites, the cash burn will be unforgiving and the multiple will compress fast. This is a high beta, high-reward conviction play on the backbone of the AI revolution. You are not betting on a product. You are betting on their ability to build. And that brings me to the question I want to leave with every one of you. Do you believe Nebius can convert 4 gigawatts of contracted power into live AI infrastructure on schedule? Or is the execution gap the hidden reason this story may ultimately disappoint? Drop your answer below. I read every single comment and I genuinely want to hear your thesis. If this breakdown gave you value today, please hit that like button right now. It takes 2 seconds and it helps this channel more than you know. If you are not subscribed yet, hit subscribe and ring the notification bell so you never miss a deep dive like this one. And if you really want to support Smart Stock Sam and help us keep producing this level of research, you can send a super thanks right here on YouTube. Every single one means the world to this channel and keeps us going. Until next time, stay sharp, stay disciplined, and I will see you in the next one.